Good morning and welcome to Options Brew TV. I'm your host Lex, and we're going to talk about a couple things. One of them is what trade would you do if you knew exactly where the stock was going to be the next day? Could be a butterfly, but let's find out. There they are. What's happening, guys? The masters of the universe, Mark from Harvested Financial, Jason from ADM Funds. Good to see you guys. What's up? Look at the eye roll. I'm with my notes.
Funds.
Oh my God.
I love your cold open voice. It is just silky and you got a face for radio, but that voice is
got a face for radio with the voice. Oh my God. All right. So first things first, we've had a little bit of a rally last couple of days. Not a little bit, a lot of it, right? So seems like 3 days in a row. Jason, I'm going to go to you, the kind of the gamma cluster boy. Anything to speak of relative to this monster rally? It's been about what, 1,000 points, I think, from when we kind of bottomed out.
Yeah, so 1,000 points. What are you watching?
Well, I'm talking about the Dow. I always refer to the Dow.
Yeah,
but the Dow was up 800 points that one day, wasn't it?
Yeah, I mean it was up quite a bit. I don't know about 800. I don't know, but it goes up quite a bit. But I mean, so I've been looking at 4,000 as kind of a gatekeeper of SPX because I look at SPX.
Yeah.
I'm a little bit newer school, I guess, than you, Lex.
No, that's the right school.
Yeah, it's been kind of a gatekeeper as far as Vanna goes. I've been wanting to see like a vol up, spot up in order to pass it. That's kind of what we've gotten. I mean, volatility has been increasing, maybe because of today's CPI or whatever. It's been kind of increasing. But I mean, I don't know. I don't have the market in front of me right now, but I mean, with CPI coming in line to expectations have fluctuated, and we kind of have to pass 4,000. And once we get there, we 100 be a next kind of pin, and we'll swing back and forth at least through next January.
Okay.
But if we can't get above 4,000, I mean, there's a chance that we can bounce back down to that like 3,800 level.
Yeah.
Not today, but you know,
some
possibly between now and next option expiration.
Okay, so you might be having a technical difficulty with your headphones. You're beeping in and out.
Okay, hold on one second. Let me.
Yeah. So, Mark, were you surprised by the CPI number at all, or not really?
Came in a little light. It felt like I honestly expected a little bit more of a rally. I didn't dig into all the components, but I guess we got our 50 spook points yesterday. So
right.
In some ways, we're almost like the news got out early to someone. It's almost like they knew where the price was going to be.
It's amazing how they know that, isn't it? I wish I had that crystal ball once in a while. I could do a specific trade that we're going to talk about now. If you know where the market's going to be the next day, or you have that crystal ball, right? Okay. So most people think, well, why wouldn't I just buy the stock? Not a bad idea, I suppose, or buy calls or sell puts or whatever, depending on which way it's going to go. But Mark, you taught me that the actual best trade is to do this butterfly, right? So go ahead. You want to say, we'll start with Mark and we'll go to Jason. What are your thoughts here? Now, make sure I teed it up correctly too.
I think my answer to this is that it is a butterfly, perhaps with a small asterisk. And that small asterisk is just a real world constraint, right? Because if you had no real world constraints, you would sell unlimited upside calls. You'd go position limit on every upside call you possibly could. That would probably be a better trade that could earn you more money. But given that there's realistically a limited amount of capital and you've got to have a certain risk framework on, if you really want to bet the farm on something, your max, bang for your buck, I do think it is a butterfly. That combination of the long call spread that you're going to go right up to your midpoint and the short call spread that you're going to sell that's above the price, the combination of those two gives you a low cost, positive cash outlay, but will reach its maximum value. It's probably something like 4 or 5 times what you pay for it if stock pins at that strike price where you think it's going.
Right. And and the idea is where this is technically going, right? So you folded in a metric that we're going to talk about after this is the risk management part of it. So there's a cash outlay and a risk component, and there's a reward component. And by doing this butterfly, you're suggesting that it's the best of both worlds, right?
Correct.
Okay. Jason, you want to weigh in on that?
Yeah, sure. So the butterfly, I would say with a little bit of a caveat, because unless that crystal ball says the market is going to pin at exactly a strike, so like, say 4,000 and it pins at exactly 4,000.00, then I would say a butterfly. But if it turns out to be 4,000.01, then I would be like a small condor around 4,000, and then like say 4,005 with only one strike spread between them. It would still get that 4x and 5x return. However, you would not have to suffer the next day risk of being exercised or something. In a cash situation, I guess it would be, in SPX, it would be okay because you just receive the cash and then you don't have the risk of whatever happens the next day. But if you're getting assigned stock, then I would want to make sure that I'm not assigned anything for the following day.
Okay. So just so we're clear on this for the viewers, butterfly, we're using the same strike in the middle twice, right? We're selling that twice. Mm-hmm. So in your example, if it goes above by a penny, that short strike, you're going to get assigned on the extra amount in that 1 by 2, right? So you're only going to have one to protect it. Whereas if you do the condor, you're going to have a call spread down below, right? Mm-hmm. And a put spread above, but they're going to be separated, the call and the put. So you're not going to have two on one line. So now in your example, the lower call that you're long is going to offset the higher call that you're short. And the risk is if it goes above the second short strike, right, which you separate by $5, that's a pretty big move. And we already said we have the crystal ball to a large degree. So
yeah, but you only have the crystal ball allegedly for one day. If you have the crystal ball for the next day, then you would do something different. Yeah, but you only have the crystal ball for one day.
Right, Mark, you on board with the condor idea?
I think it's a very interesting point about the maximum will always be if whatever your source tells you picks a round strike. That's of course the best. That's where you're really going to get that bang for your buck. But to the extent that it's between, and I've been trying to think about this as Jason's been talking, there's probably some trade-off. I don't know if it's 0.001, and cash settles is obviously an interesting point, but there's probably some trade-off where a condor starts getting better the further away you are from a strike, and where a butterfly gets worse. I don't know that it's exactly a 0.01, but I think he raises a very good point about a predicted price or a future price that's going to be in between strikes.
Yeah. I kind of like, go ahead, I'm sorry, Mark.
I was going to say the other real problem, like SPX cash settled, that's fantastic. But, getting out of butterflies on expiration is a huge nightmare, right? Yeah. No one wants to take them on that, there's real thin liquidity, to the extent that you say your butterfly should be worth that maximum $5 or whatever. It's not going to be worth anywhere close to $4 until the hour before expiration. And maybe you're $4.50 with 2 minutes before expiration. Yep. Getting out of those is a real dicey game, even in top tier traded names like SPY.
Right. Yeah, no, I agree. Yeah, and the problem is, as you said, that short strike that is right at the money, and you got to worry about a penny above, a penny below, and you got negative gamma, right? And you're just constantly, I always was like, oh, come on, I hope it stay right here, just under the strike. I don't want to have to worry about assignment. But it can be tricky. I think I'm kind of warming up to the condor idea. I believe. I think it takes one element out, and of course, I didn't even think about cash settle versus actual asset. But you would do this in the SPX, then that's another part of the component in the trick, is it's got to be a cash settled sort of entity, not a deliverable.
Yeah.
And you'll pay 60-40 long-term taxes on your winnings.
Yeah, I'm with you. I think I like that. I'm digging it, Jason.
The only question though is the margin you'll like this the amount of size you'll be able to do, right? Like that condor, you're going to have to post margin for a full spread. Whereas the butterfly, if it's a debit, you might be able to get more, right?
No, I mean, if you're going to be doing, it's going to end out to be the same thing. It's just that you get the credit and then you have to do that, whatever, if it's like a $5 spread there minus the credit, and that will equal whatever you have for a debit. Like if you do an iron fly and you get it for a credit, it is the same outlay as if you do a regular fly for a debit. It's just the, I guess the accounting is a little bit different. But, you receive cash as opposed to spending cash. But it still comes out to be the same. You can't do like an iron fly around a strike and then do a regular fly around the strike and get two different prices.
Yeah.
No, I think the prices should be the same, but in terms of like maximize it, like if you have $1 million in this account, that will you be able to put on more butterflies with the debit?
Oh, I see what you're saying. Scaling.
Yeah, than the $1 million worth of margin, like $1 million worth of condors. You have to be able to put up that $5 spread for every single contract you do. Whereas if a butterfly, if that's less than that, you should be able to get more contracts.
Yeah, I'm thinking about the condors not being an iron condor, though. Is that what we're talking about? I'm thinking about take the call side and doing a lower call spread, a debit, and a upper call spread credit, not an iron condor where they're both credits. So you're going to get a debit out of that trade, right? On the regular condor, not an iron condor. So now you've done all you're doing is you're doing a butterfly, right? And you're stretching it out. You're just pulling the lower part out and pulling the upper part up. And now you've got a condor, right? So I'll look at it on TradeHawk and find out what the margin is. I'll get back to you on that. But I think it's going to be similar.
Yeah, they're very similar because the debit comes off your margin, and with credit, it's just the spread minus the credit. Yes,
that's right.
And it comes out to be about equal.
Yeah, I think that's right. I'm curious now that Mark brings this up. I want to find out. So I'll put some value. I'll put like a 100 lot in and figure out. I'll give both examples.
Yeah,
so.
I'm curious. I'm not an expert in the margin, right? And
yeah, me neither.
It might depend if you're on portfolio margin versus Reg T margin.
That's true too. Yeah. So, margin was something we never looked at. At least I never looked at. That was for the risk managers. If I was over,
Sam Bankman-Fried said.
Right. If I was over margin or I had too much on, they tell me you're take something off. I'm like, okay, great. Sounds easy enough. It's like taking sweaters off. Peel one off, you're good. All right, good. So for the last few minutes, you bring up risk management. Let's move into that because that's what we're supposed to be talking about anyway. What I mean by risk management, I've had some inquiries via email and kind of questions about risk management. So let me get your thoughts on the concept first of all. And here's what I'm going with it. So there's a trading element, putting the trade on. There's a management of the position, which is sort of risk management, and there's what sort of kind of strategy and outlook do you have to actually put on a position because of risk management? And is there anything combined into all that you need to pay attention to? And I'm going to kind of hack at it from the pro side, what we used to do, and maybe Jason and tag at it from maybe a retail perspective on your thoughts about this. So Jason, I'll start with you if that's okay. Do you understand what I'm getting at?
Yeah. You're talking about how managing risk on a trade during a trade. Are we talking more about options or just in general?
I would say let's focus on the option side of it. I think because my feeling is that the retail folks get automatic risk management from the margin people, right?
Yes.
Right away. So that's probably already built into the system. But look, there's things you could do that with your money that are riskier than others. So that's kind of where I'm going.
Yeah, I mean, the first thing to recognize is that you're not always right. And the really big problem with retail and in myself included, I mean, I'm not going to put myself as an exception, is sometimes there's risks that you don't necessarily account for.
Mhm.
And, like say liquidity risk or something, where a lot of people talk about diversification as risk management, but, in the market over the past year, bonds, gold, stocks all went down. So if you diversified into all these different asset classes, you sunk, there was no risk management. And a lot of that is, so there's always going to be risks that you're not going to account for. You're not going to know everything. So a lot of risk management to me is position sizing and trying to and trying to have, sometimes when you have like kind of dispersion trades, I think if one of these risks happen, this trade will go up while this trade goes down, and I'll net positive in the end. Try to have dispersion and position sizing is the biggie.
Okay, that's good. Mark, do you have any thoughts on this?
Yeah, I couldn't agree more with the position sizing comment. And I think to Jason's point also, right? Like remembering how much you're going to need to earn back based on a given loss that you do, right? If you lose 50%, you need to make 100% to gain that back. And the name of the game with trading is always being able to stay in the game. So that all comes down to that position sizing. And, one of the things, sort of the rubric, I don't know if I'd recommend following it to the letter of the law, but an interesting rubric to think about that position sizing is the Kelly criterion, right? The sort of relationship between your confidence in that, trade versus your size and sort of how much of your stack you should bet on it. And I don't think anyone actually goes full Kelly. I think a more common implementation is that, to the extent that people are making, per trade decisions, half Kelly is even considered fairly aggressive. But essentially the idea of sizing your trade, your position relative to your conviction in that and how much quote unquote edge you think you might have in that position.
So is this Kelly criteria? This is a percentage of your balance, of your equity that is it amount to that ultimately?
Exactly. Like the output is going to say, this is how much of your stack you should bet on this trade, given, how confident you are and how much you think you can make.
Yeah. Okay. I think I think that these are great points especially for the retail folks, because as I alluded to when I first teed this one up, I don't think retail folks, unless you have a lot of money, can really do much with, short units and just naked selling calls and puts. I don't think it exists really. Some people can, if they have a lot of money, but then you get back to the size of your position relative to the shorts. So I think it's a little bit built in, the risk management part, but I guess, trades are going to go against the retail trader. They're going to go against the pro trader. And then you have to either make a decision to massage the risk and the position or not. Right. And my feeling is that a lot of these retail folks, they have a directional bias to the reason that they put on a position in the first place. It's something about the underlying that they believe in. Okay. And that's okay. There's nothing wrong with that. So therefore they're going to take natural long deltas, when the stock goes down, if it's the negative gamma, and the opposite when it goes up, because they're just believing in the inventory. Whereas I think, Mark, you and I in the old days of market making, it wasn't like that. So we always taught it was really easy. We could find anyone to put a position on. That was the easy. I could find any person, hire anyone to get down there and be fast and get on a bid or an offer. What's so hard about that, right? The real critical part to us was, what do you do with that inventory once you get it on? And the best traders we always found were the ones who could be quick on the floor in the competitive days, get in, and be amazing at managing the inventory. And those guys were by far, and gals were by far the best that we've ever seen. And I put more emphasis on the risk management part, knowing when you look at in a negative gamma position, especially, you have to make a decision on when you're going to pull the plug and say uncle, right? And there's not exactly a scientific answer to that. So I don't know if you feel similarly, Mark, about those kind of days.
Definitely. And I mean, I think one of the things I always say about liquidity is that it's the ability to get into and out of a position, right? People only think about it on the get in part. But, to that butterfly example we were just talking about, if you're running your model and you think, hey, this is going to make me, $5 for every $1 I put in, but you can only get out for $4 because there's actually no liquidity to trade out of that butterfly at expiration. Like, your estimations, your sort of like risk reward calculations are going to be off. So you always have to be thinking about when you're going to get out, how you're going to get out, what's the worst case scenario that's going to happen here.
Yeah.
Is someone going to take my trade when I need to get out of it?
Yeah. Right.
Mhm.
Jason, do you think the retail folks that you deal with, are they more credit spread folks and just say, I'm going to throw this $1 credit spread out there for 40 cents. I know I can make 40 and I can lose 60. It sounds like a horrible relationship, but it depends on, kind of the delta dynamics and where that spread lies, et cetera. What do you think?
Yeah, it depends mostly on not just delta dynamics, but just the probability that trade will succeed. I mean, if you're gonna flip a coin and lose 30 cents for every 70 cents you win, you're probably that coin. The person you're going against is probably gonna have a weight on one side of the coin.
Right.
And that's there are a lot of credit spread people out there, a lot of option sellers. I think a lot of the retail people that I end up talking to are more just desperate to know a direction because you seem to make more on delta than on anything else.
Sure.
And it's and that's also delta and gamma. So it's hard to predict something like volatility. So
Yeah.
I think and I think too, in order to sleep at night, people like long gamma trades more than short gamma. But there's some people out there that enjoy that short gamma, that constant flow of positive.
Yep.
Just have to outlive some of those big negatives.
Yep. Yeah, I think, and I want to make a distinction too. We're talking about the world of, I'd say, trading more than investing here, right?
Yeah.
In terms of risk management. Investing, you have a pool of assets, stocks, let's say, and you sell some calls against them and you're trying to enhance your income, let's say. That's a lot different than, I'd say, the risk management part. Although there comes a time when the best risk managers say, I believe in this stock XYZ, and here's all the fundamental reasons why I believe in it, and I want to hold it for long term, and they change their mind and they read some other piece of data or they have another data point that says, I wasn't right about this. Time to get out. That's risk management. They make a decision to close the position and move to the next one. So that's another part of risk management in the investing world that occurs. So it happens at every level. And I think the people who do the best in this business are the ones who understand their particular lane of risk management, right?
Yeah.
So, all right. Cool. Guess what?
It's always something, though. I mean, just to say, it's always something that even I'm constantly learning. I mean, the Kelly criteria is great, but how do you quantify your confidence in a position? I mean, it's always something that you kind of have to learn. And every time I watch something on risk management, it always seems like the people are so solid in risk management that they know exactly, it is a constant learning process. So don't get discouraged if you screw up once or twice.
Yeah, no, that's a good point. Good point. Mark, were you going to say something? We're gonna run here, I think.
No, I think Jason's point about the Kelly criterion is perfect, right? Like we can take his coin flip example and run that through the Kelly criteria. How big should you bet on a 30-70, fair coin, but how, the edge of that, right? Whereas you don't know the edge of the true value in, the platonic sense of that true value.
Yeah,
right.
No, that's a good point. Good points. All right, gents, good to see you as always. I've been kind of peeking at the market back and forth. It seems like we're moving all over the place for now. Still down a little bit, mildly. Although the NASDAQ is down 0.7%. That's not that bad. Jeez, what am I saying? It's like another walk in the
You're
park.
war weary from the past year.
Oh, God, this
70 basis points, no big deal.
No big deal. My gosh. All right. Well, you guys have a good weekend. We'll talk after. Good to see you as always.
Happy
All right,
trading.
take it easy,
Happy
Lux.
trading.